this second part of the presentation on financial derivatives, we would be discussing about options contract. In the first part, we have discussed about forwards and futures contract. So in case if anybody wish to have a look at it, I'm just giving the link below. Please do check out that video. And in this presentation, we are trying to cover the definition of options and the types of options and the concept of option. In the types of option, I'm just covering the put options and call option. The other variants like American, Bermudan, Asian options are not covered in this presentation. And then the option pricing, how the premium or the price of the option is determined and what are the constituents of that. And then option transaction, how options are transacted in an actual marketplace. Then how a hedger and a speculator uses an option contract. And then the role of a market maker in the options market. An option contract is an agreement between two counterparties, a buyer and a seller, to exchange an asset on a future date at an agreed price, wherein the buyer of the contract will have a right to execute or not to execute a contract, but a seller of the contract will have an obligation on the contract. Many people consider the concept of option as a maze or rather a confusing thing, but actually there is no need for confusion. The only thing is like we need to understand the concept in its granular level. So that being the case, let's restate the definition once again. An option contract is an agreement between two counterparties to exchange an asset on a future date at an agreed price, wherein the buyer of the contract will have a right to execute or not to execute a contract, but a seller of the contract will have an obligation on the contract. And we have seen that the basic difference between a normal transaction and a derivative transaction is, in a normal transaction, the buyer and the seller agree on the price and quantity today, and they will also exchange the asset and the cash today itself. But when it comes to derivatives contract, they will agree on the quantity and price today, and they will postpone the exchange to a future date. So here, in option contract also the future date is mentioned, and the future date which is mentioned during the contract is referred as a strike date. So strike date is also referred as an expiry date in the case of a European option, and the contract will have an agreed price, and the agreed price which is mentioned there in the contract is referred as a strike price. And the next important thing is about the option contract is it is a right. It is a contract which gives the buyer of the contract a right. So this right in the contract can be a right to buy the asset. So it's important to understand that it is a right to buy. What it means is that the buyer of this contract can decide whether to execute the contract or not to execute a contract on the strike date. Similarly, the right can be a right to sell. So somebody who buys this contract, they will acquire a right to sell the asset or not to sell the asset. Decisions on them on the strike date. So the right lies with the buyer of the contract. And then a right to buy option is called as a call option. A right to buy contract is called as a call option. And a right to sell contract is called as a put option. So the right is lying with the buyer of the contract. And the seller of the contract, he doesn't have the right, he has got an obligation. If it's a call option, which is a right to buy option, the seller of the contract will have an obligation to sell. He has to oblige to the decision taken by the contract buyer. So for example, a call option is a right to buy option. So on the day of execution, on strike date, the buyer of the contract will decide whether to buy or not to buy. If the buyer of the contract is deciding to buy the asset, then seller has to oblige it. So seller has to sell the asset to him. He doesn't have a choice. On the other hand, if he is deciding to not to execute a contract, he doesn't have to do anything. And when it comes to put option, the seller of the put option seller of the contract will have an obligation to buy. So it is a put option is a right to sell contract, which means that on strike day, the buyer of this put option can decide whether to sell the asset or not to sell the asset, depends upon the market situation. If the buyer of the put option is deciding to sell the asset, the seller of the put option contract, he has got an obligation to buy it from the put option buyer. So these differentiations are very important to understand the concept of options contract. And now let's consider the entities which we have discussed in the first presentation. That's ABC Limited, which is a coal mining company, and XYZ Limited, which is a thermal power generation company. So we have seen that both of them have got into a forward contract like this in order to insulate themselves from the market fluctuations of coal price. So the forward contract was exchanged 10 tons of coal at rupees 2,500 per ton on March 31st. March 31st is a future date. So they are, by getting into a contract like this, they are insulating themselves from the fluctuations of coal price because they want to protect their profit margin. And we have seen that ABC Limited's interest profit margin would be affected if the coal price goes down in the market because they are the sellers of coal. And XYZ Limited, their profit margin will get affected if coal prices goes up in the coal market. So because that will increase the cost of electricity produced by them. So in order to protect their profit margins, they got into a contract like this so that they can insulate from the future price fluctuations of coal in the market. Okay. Yeah. Now, if you want to make this contract a options contract, just replace the word exchange with right to buy. So this is a right to buy contract, which means that this is a call option. So what does contract mean is that XYZ Limited is the buyer of the asset. So on March 31st, XYZ Limited has got a right to buy 10 tons of coal at rupees 2,500 rupees from ABC Limited, and the date is March 31st. So on March 31st, XYZ Limited can decide whether to buy the coal from ABC Limited or not to buy the coal. Depends upon the market situation. Say, for example, if the market price is going down to 2,400 rupees on March 31st, then XYZ Limited can choose not to buy this coal from ABC Limited. That's why it's a right to buy contract. Option contracts are right to buy contracts. The buyer of the option will get a right. He doesn't have an obligation. So here the seller of the option contract is ABC Limited and buyer of the option contract is XYZ Limited. So since ABC, okay, and the buyer of the asset, that's coal, is XYZ Limited, and seller of the asset is ABC Limited, the coal mining company. Okay, and since ABC Limited has sold this particular contract, they have got an obligation to sell, which means that on March 31st, whatever decision XYZ Limited is taking, ABC Limited has to apply to that one. If the XYZ Limited decides to buy coal on March 31st, they have to sell the coal at 2,500 rupees, irrespective of the market price. The market price can be above those 2,600 rupees, but doesn't matter. They have taken this obligation by selling the contract to them. So for taking this obligation, your XYZ Limited will get a premium from XYZ Limited. So ABC Limited, for taking this obligation on this call option, they will receive a premium from XYZ Limited. So premium is nothing but it's the price of this particular contract. It's the price at which ABC Limited has sold this particular contract to XYZ Limited. All right. If you want to make this call option a put option, all you have to do is change the word right to buy to right to sell. Now it has become a put option. So a right to sell 10 tons of coal at rupees 2,500 rupees per ton on March 31st. So what it means is that ABC Limited, which is a coal mining company, it has got a right to sell 10 tons of coal at rupees 2,500 per ton on March 31st to XYZ Limited. And ABC Limited has got a right, which means that on March 31st they can decide whether to sell or not to sell. Okay, so here this is a put option, and seller of this contract is XYZ Limited. This is a right given by XYZ Limited to ABC Limited. So they are the seller of the contract, and ABC Limited is the buyer of the contract. And here the asset is called, and the seller of the asset here is ABC Limited. They are selling the asset, and XYZ Limited is the buyer of the asset. Again, this differentiation is also very important from understanding call option, put option, options in general. So when it comes to a call option, which is a right to buy option, for the seller of the option contract and seller of the asset are same, and buyer of the option contract and buyer of the asset are same. But when it comes to put option, which is a right to sell option, the buyer of the contract will be the seller of the asset, and seller of the contract will be the buyer of the asset. So get that particular clarity, and it is absolutely important. Since it is a right given by XYZ Limited and it is a right to sell, XYZ Limited will have an obligation to buy. On March 31st, if ABC Limited is deciding to sell the coal, then they will have an obligation to buy. And for taking this obligation, they will receive a premium. Okay, and so premium is nothing but it is the price of the option contract. It is the price an option buyer pays to the option seller. And more about option premium, we will discuss it in a short while. Okay, now let's get our entities, that is ABC Limited and XYZ Limited. And right to buy 10 tons of coal at rupees 2,500 rupees per ton on March 31st. This is a call option. So this is a call option given by ABC Limited to XYZ Limited. So on March 31st, XYZ Limited has got a right to buy 10 tons of coal at rupees 2,500 rupees per ton. So here the seller of the call option is ABC Limited and buyer of the call option is XYZ Limited. And since XYZ Limited is the buyer of the call option, they will pay a premium to ABC Limited, who is the seller of the call option. And let's assume that the premium paid by XYZ Limited is rupees X. All right. And now let's see what happens on March 31st. On March 31st, if the spot price, that's the market price of coal, is rupees 2,600, then what is the best course of action for XYZ Limited? So here the market price is more than the strike price. So as far as XYZ Limited is concerned, it is better for them to buy coal from ABC Limited at rupees 2,500 rather than buying it in the market at rupees 2,600. So they will decide to execute a contract. So when they decide to execute a contract, they will get a gain of rupees 1,000. So they can buy the coal. So just you can also think it in this way. They can buy the coal at 2,500 rupees from ABC Limited and sell it in the market at 2,600. So they will get a gain of rupees 100 per ton, and the total value mentioned in the contract is 10. So 100 into 10, their total gain would be 1,000 rupees. And this 1,000 rupees will be the loss for ABC Limited. Okay, ABC Limited is losing an opportunity to sell the coal at rupees 2,600 because of this particular option contract. And on March 31st, they don't have a right, they have got an obligation because they are the sellers of this particular coal option. Okay, but they have some respite. They have received rupees X as premium. So their total loss would be the difference between the market price or the spot price and the strike price minus the X, the premium which they have received. Okay. On the other hand, if the spot price on March 31st is 2,450, which is lesser than the strike price, then for XYZ Limited, it is better for them to buy coal from the market rather than buying it from ABC Limited at rupees 2,500 rupees as per the contract. So they will allow the option contract, the call option, to expire. They don't take any action on that particular contract. So they will incur a loss of rupees X, which they have paid as a premium to ABC Limited, to seller of the call option, at the inception. And on the other hand, ABC Limited, since XYZ Limited has decided not to take any action on this particular contract, they will keep that particular premium and that will become their gain. So you can see that as far as a buyer of a call option is concerned, he will have unlimited gain. As and when the market price of coal goes up, that will translate into a gain for XYZ Limited. And their loss is limited only to the premium which they have paid. And even if the price falls, price becomes lesser than the strike price, they don't have to worry. They can because they can just decide not to take any action on this particular contract. So their loss on this contract is limited to the premium which they have paid. On the other hand, when it comes to ABC Limited, they will have an unlimited loss. How much ever the spot price of coal goes up, that will translate into a loss for ABC Limited, and their gain is limited only to the premium which they are receiving. So in a call option, the buyer of the call option will have unlimited gain and limited loss, and seller of the call option will have unlimited loss and limited gain. And so if you want to summarize what we have discussed, if the spot price is more than the strike price, then the buyer of the call option will decide to execute a contract. The contract is profitable for them. So a option contract which is profitable to the buyer of the option contract is commonly referred as in the money contract in the market parlance. So on the other hand, if the spot price is lesser than the strike price, then the XYZ Limited, the buyer of the call option, decides not to execute that particular contract. So the contract is not profitable for them. So a option contract which is not profitable for the buyer, it is referred as out of the money contract. And if the spot price and strike price are equal, then you call it as a at the money contract. Okay. Now let's get the put option on the screen. So ABC Limited and XYZ Limited are the counterparties here. So it's a put option. It's a right to sell 10 tons of coal at rupees 2,500 rupees per ton on March 31st. So it is a right given by XYZ Limited to ABC Limited. So buyer of this particular put option is ABC Limited, so that they will get a right to sell 10 tons of coal at rupees 2,500. And here the seller of the contract is XYZ Limited. So since they have sold the contract, they will receive the premium, and we are assuming the premium is rupees X. And on March 31st, the first scenario is the spot price is rupees 2,600. So if this is the scenario, as far as ABC Limited is concerned, it is better for them to sell it in the market rather than selling it to XYZ Limited at 2,500 rupees. So that being the case, they will incur a loss of rupees X, which is the premium which they have paid. And seller of this particular put option contract, XYZ Limited, since they don't have to take any action on this particular option contract, they will keep that particular premium, which will become their gain. And on March 31st, if the spot price is 2,450, which means that if this is a right to sell option, so as far as ABC Limited is concerned, rather than selling it in the market, it would be better for them to sell it to XYZ Limited at 2,500 as per this particular put option. If that's the case, they will gain rupees 500. That is the difference between the market price and the contract price, strike price, which is 50, and the quantity which is mentioned during the put option. And this will become the loss for XYZ Limited, but they have received a premium when they sold this particular put option. So that premium will cushion that particular loss. So their total loss would be rupees 500 minus the premium which they have received. So here the ABC Limited, their gain can be unlimited. So whenever the market price or the spot price of coal goes down, what it means is that they can buy coal at that particular lower price and sell it to XYZ Limited at 2,500 rupees. So they will have unlimited gain in this particular put option, and their loss is limited to the premium which they have paid. On the other hand, when it comes to XYZ Limited, they will have unlimited loss. Whatever the coal that they buy it from ABC Limited at 2,500 rupees, if the market price goes down, they will realize only lower amount when they sell it in the market price. So they will have unlimited loss, and their gain is limited only to the premium which they have received. So they will have limited gain here. So if the spot price is lesser than the strike price, then you can say a put option is in the money. It is profitable for the put option buyer. And if the spot price is more than the strike price, the contract is out of the money. It is not profitable for the put option buyer. And if the spot price equal to strike price, then you call it as at the money. Now the premium. What determines the premium of an option contract? How the premium or the price of an option contract is calculated? The premium of an option contract comprises of an intrinsic value and an extrinsic value. An extrinsic value is also termed as a time value. Intrinsic value is nothing but it is the difference between the spot price and the strike price, the price which is mentioned there in the contract. Extrinsic value or time value has got components like distance between strike price and spot price, time to decay, that's the number of days to expire as far as the contract is concerned, and then interest rate, the prevailing interest rate in the market, or you can also term it as a risk-free rate of interest, and the volatility. Volatility is a measure of risk. How much the price of the market prices are varying from a particular standard, a measure of central tendency. And whenever the volatility is high, the risk is high, the premium will goes up. Okay, now let's consider a call option, that is right to buy 10 tons of coal at rupees 2,500 rupees per ton on March 31st. The strike date is March 31st and strike price is 2,500 per ton. This is a call option, and let's here the strike price is 2,500, and let's consider this call option on March 31st. And on March 31st, the spot price is 2,600. The market price is 2,600. If this is the case, if somebody is buying this, having this particular option, the holder of this particular call option, he can buy the asset at 2,500 and sell it in the market at 2,600 and get a profit of rupees 100 rupees. So when you calculate premium, premium comprises of a intrinsic value, which is nothing but the difference between the strike price and the market price, plus, so that becomes the intrinsic value, plus the time value or the extrinsic value. So here time value, the option will not have any time value because you are in March 31st and the option is expiring on the same day. So on the day of expiry, the option will not have any time value. Okay. Now, if this is the scenario on 20th February, and on 20th February, as far as this option is concerned, it has got 31 more days to expire. Okay. And we are considering the spot price the same as 2,600. If this is the scenario, what would be the premium? The premium comprises of the intrinsic value, that's the difference between the strike price and the spot price, which is 100 rupees, plus time value. And we know that time value, the components in time value, that is the distance between the spot price and the strike price, which is 100, and time to decay. We are on 20th February, which means that the option is expiring on 31st March, so it will have 31 more days to expire. and interest rate. Let's say assume that interest rate is 10% and volatility. So what it means is that this difference between the spot price and strike price, for the seller of this particular call option, he has to carry this particular 100 rupee, the risk of this 100 rupee for the next 31 days at an interest rate of 10%. And you have to also consider the volatility, that is a risk in the market. And since you have multiple variants, multiple variables, you need a statistical model to calculate this time value. And the statistical model used is a Black-Scholes model. There are other various also, other models also, but the popular one is the Black-Scholes model. And we will discuss about Black-Scholes model in another presentation. So for the time being, your time value comprises of your distance between spot price and strike price, time to decay, interest rate, and the volatility. So what it means is that the seller of the option has to carry this risk of the difference between spot price and strike price for 31 days at an interest rate of 10%. And let's assume that that value is X. So the premium is your intrinsic value, which is 100 plus X. So somebody wants to buy this particular call option, they have to pay a premium of 100 rupees plus X. And now you have the same call option here, right to buy 10 tons of coal at rupees 2,500 per ton on March 31st. What if the spot price is 2,450 on 31st March? Here basically this is an option contract which is out of the money, which means that if somebody is having this holder of this particular call option, it is better for him to buy it from this particular market rather than buy it from the contract seller. So option, it is better for him to let the option contract expire. So as far as the premium is concerned, it will not have any intrinsic value. So the important thing here is only in the money contracts, in the money option contracts will have intrinsic value. Out of the money contracts will not have intrinsic value. And the option is expiring on March 31st. So it will not have any time value. So this option will expire worthless. Nobody will be willing to pay any money for this particular option contract. Now, if this is a scenario on 20th February, your spot price is 2,450, and if you calculate premium, and we know that only in the money contract will have intrinsic value, and this is a out of the money contract, so it will not have any intrinsic value. But it will have 31 more days to expire, so it can have a time value, so it can have an extrinsic value, so that value is X. So if somebody is buying this particular option contract, right to buy contract, hoping that the market price on March 31st, in another 31 days the market price might go up, he will have to pay a premium of X rupees. Now let's consider a put option. That's a right to sell 10 tons of coal at rupees 2,500 rupees per ton on 31st March. So this is a put option, and here the spot price is rupees 2,600 on March 31st. So we are considering this scenario, and if this is the scenario, if you calculate a premium, how does it look like? Say, as far as the holder of this put option is concerned, it is better for him to sell it in the market at rupees 2,600 rather than selling it to the person who has given him this particular contract, because he will realize 100 rupees extra per ton. So this contract will not have any intrinsic value. This is basically an out of the money contract, and it is March 31st, which means that the contract will not have any time value as well. So this contract will expire without any value. And as discussed in the previous example, if this is the scenario on 20th February, that the spot price is 2,600 and the date is 20th February, and this is the put option, then it will not have an intrinsic value, but the option contract will have 31 more days to expire, which means that it can have a time value. So somebody who wants to buy this particular contract at that point in time, he has to pay X rupees as premium to the option seller. Okay, now let's consider a scenario on 20th February wherein the spot price has become 2450, which is lesser than the strike price, and we know that a put option becomes in the money if the market price is, or the spot price is, lesser than the strike price. So if you calculate a premium, it can have an intrinsic value. In the money contracts will have an intrinsic value, which is the difference between the strike price and the spot price. So 50 rupees is the intrinsic value, and the contract also has 31 more days to expire. You are on 20th February, so it will have a time value of rupees X as well. So if somebody is buying this particular option contract on 20th February when the spot price is this, then you can have a you will have a premium of 50 rupees plus X rupees. And to sum up whatever that we have discussed as far as option pricing is concerned, option premium comprises of intrinsic value and extrinsic value. Extrinsic value is also known as time value. Intrinsic value accounts for the major part of the option premium, and only in the money contracts will have intrinsic value. Out of the money contracts can have extrinsic value or time value if there is time to decay. And on the day of expiry, in the money contract will have only intrinsic value and no time value, and out of the money contract will have neither. And a call option gains value when the market price of the underlying asset goes up, and put option gains value when the market price of the underlying asset goes down. Extrinsic value or time value will be diminishing with the expiry of time. Now let's see how you can transact in an option. How do you trade an option in a market? The trading in an option is slightly different from how the concepts that we have discussed so far. And to buy an option, buying an option is termed as taking a long position in the option contract in the market. And you are buying either a call option or a put option, and we know that you have to pay a premium to buy the option. And how the premium is calculated we have already discussed. And in order to square off your option position, you have to sell it. So before expiry, you have to sell the option in the market to square off your position. Okay, now let's see how does it work. Let's consider a situation. You are buying an option contract, a call option of a share whose and the share price is rupees 100, and it is a 3-month contract that you are buying, and the strike price is also rupees 100. So you are basically buying a call option with a strike price of rupees 100 for a share whose market price is rupees 100 at that particular point in time, and you are buying a 3-month contract. And if this is the situation, what is the premium that you have to pay? We know that since the strike price and the market price are the same, it will not have an intrinsic value, but the option has got 3 months to expire, so it can have a time value, and assume that that particular time value is rupees 3. So the premium a call option buyer has to pay is 3 rupees. And let's consider a scenario 1 month after this, and after 1 month the share price has become rupees 110. Alright, and let's calculate the premium of this particular contract at this particular point in time. So since it's an in the money call option, because the market price or the spot price is higher than the strike price, so it's an in the money call option, so the option will have an intrinsic value, which is the difference between the strike price and the spot price, which is 10, and it will have a time value of rupees 2. So when we bought this particular contract, the option contract had 3 months to expire. Now it is a 2-month contract. It has got only, let's say, 60 days to expire. So the time value will come down, and the time value is rupees 2. So now the premium of this particular option is rupees 12. And from this you can see that the premium comprises mostly of intrinsic value, and the time value is accounting only a minuscule part of the premium. All right, and if this is the scenario, let's so basically what this particular call option buyer has to do is, like, if he wants to square off his position at this particular point in time, he has to sell off this particular option in the market, and he will be fetching a premium of rupees 12. All right, and let's consider a situation in which somebody, or let's compare a situation in which somebody is investing uh, in this particular share. That means he is paying rupees 100 for buying this particular share and selling it after 1 month. And let's compare that with somebody who is taking a position in the options market. Okay, yeah. So profit from cash transaction is 10%. That is the difference between the buying price and the selling price, 10%. And if you look at the options investment, he paid 3 rupees and he is exiting, he is selling at 12 rupees, so his profit is 9 rupees. So that is a 300% return on his original investment of 3 rupees. And this is the reason why your speculators prefer a option contract or investing in options rather than investing in a cash market. So with option investments, your gain can be unlimited and your loss is limited to a maximum of rupees 3, which is the premium which you have paid. And now let's consider a situation wherein somebody wants to sell an option contract. Okay, and selling an option is termed as taking a short position in the market. So you want to sell an option contract, and it can be either a call option or a put option. And we know that when you sell an option, you will receive a premium. But in actual scenario, for you to take a short position in the option contract, you have to pay a margin. You have to pay a margin to the exchange. The reason is, till the contract expires, you have a unlimited risk on this one. So because of that reason, you have to pay a margin to the exchange to take a short position in the option contract, or if you want to sell the option contract, you have to pay a margin to the exchange. And if the option is expiring out of the money, if the option is expiring out of the money, which means that the buyer of the option contract will not ask you to execute the contract, so you can keep the money, you can keep the premium. If that's a scenario, on expiry, the exchange will return you the margin plus the premium. On the other hand, if the option is expiring in the money, then the buyer of the option contract will be executing it in the market. So if that's the scenario, then the exchange will take out the loss from your margin account and only pay the rest of the amount to you. Okay, and the loss can be the difference between the market price and the spot price. So this is the way an option is transacted. So the important thing is, like, in order to buy the option, you have to pay a premium, and when you sell an option, you have to pay a margin to the exchange. And if the option is expiring out of the money, the exchange will return you the margin plus premium. And if the option is expiring in the money, then the exchange will take the loss amount from your margin account. Now let's see how a hedger uses an option contract to hedge his business position. So for that, let's consider the same example of ABC Limited. ABC Limited is the seller of the coal, and XYZ Limited is a thermal power corporation which uses the coal, which buys the coal and produce electricity. And for ABC Limited to hedge its position, so in order to hedge, they have to buy a put option which says a right to sell. So with this particular option, they can protect their business interest, because on March 31st, even if the market prices goes below 2,500, they can sell it to XYZ Limited at 2,500 rupees because of this particular contract. So they will buy a put option, or they will go long on put option. And let's see, on March 31st, if the spot price is lesser than the strike price, that means if the spot price is 2,400 for ABC Limited, it is better for them to choose to execute a contract and sell 10 tons of coal at 2500. Otherwise, if they are selling in the market, they will realize only 2400 rupees per ton, which means that if spot price is less than strike price, they will execute a contract. On the other hand, if the spot price is more than strike price, that is, if the spot price is at 2600 for ABC Limited, it is better for them to sell it in the market rather than selling it to XYZ Limited at 2500 rupees as per the contract. So since it's a right to sell option, since it's a put option, they can decide not to sell also. So they will decide the contract, they will not take any action on this particular contract. Instead, they will sell it in the market. So this is the main advantage of hedging the business interest using an option. And we have seen ABC Limited and using a futures contract to hedge its business position in the first example, in the first presentation. But in a futures contract, both the counterparties has got an obligation, which means that if the spot price is going above the strike price, then ABC Limited is losing an opportunity to sell it in the market at a higher price. So that situation does not arise in an option contract, because in an option contract, they have the right to choose not to execute this particular contract as well. So if that's the case, if XYZ Limited, who is the buyer of the asset, if they want to protect their business interest, to hedge, they have to buy a call option. So they have to convert this option into a call option, and the call option would be saying right to buy 10 tons of coal at rupees 2500 per ton on March 31st. Okay, so they have to basically go long on a call option. They have to buy a call option. So, and on March 31st, if the spot price is more than the strike price, that is, if the spot price or the market price is 2600, they will choose to execute the contract. So it is better for them to buy it from ABC Limited at 2500 rather than spending 2600 rupees in the market to buy the coal. On the other hand, if the spot price is lesser than the strike price, they can buy it from the market and choose not to execute this particular contract. So here they don't have an obligation, they have a right to decide whether to execute or not to execute a contract. And let's consider the speculators as well, Tom and Harry. So Tom is expecting the coal prices to go down, and he want to make a profit based on his view on the asset price movement. So he is basically bearish on the coal price. So if his view is bearish, in order to make profit based on his based on his view on the price movement of coal, what he has to do is like he has to buy a put option. He has to go long on put option. So when the coal prices goes down, his put option will gain intrinsic value. On the other hand, Harry is expecting the coal prices to go up, and he wants to profit from that view on coal prices. So basically he is bullish on coal price movement, and if he is bullish on coal price movement, all he has to do is like he has to buy a call option in order to profit from that particular view, or profit from that particular bullish view. So if everybody is a buyer in the call option market, who will sell contracts in an option market? And for that, let's consider a option contract, an option contract with a strike price of 2500, and put option premium for that call is put option premium is rupees 100, and call option premium for the same strike is also 100. This kind of scenarios rarely happens, but theoretically an at the money contract can have premiums of both put option and call option same. So just for explaining this thing, let's assume that at this particular strike, the put option premium is 100 and call option premium is also 100. And now if somebody is selling this particular put option, somebody is going short on this particular put option, he will receive rupees 100. The premium he will receive. All right. And he is expecting the market would be bullish, because if the spot price on expiry goes above 2500, the buyer of this particular put option, it would be better for him to sell it in the market rather than selling it to this individual who has sold this particular call option. So he is expecting the option to remain out of the money. For a call option, for a put option to remain out of the money, the spot price has to be above the strike price. He is expecting the asset prices to go up. But he is expecting the asset prices to go up, then for making money, he can buy a call option. And let's analyze that situation. So if he's buying a call option, then he has to pay the premium, that is 100 rupees. And let's take a scenario on March 31st. As per his expectation, the spot price has gone up. Spot price has become 2,575. And on March 31st, we know that the option contract will not have any time value, but it can have an intrinsic value. Intrinsic value is the difference between the strike price and the spot price. So the option value is 75. So if he is selling the option, he will be realizing 75 rupees on March 31st. But for buying this particular option contract, he has incurred 100 rupees. So though as per his expectation, though asset price has gone up, he is still not making a profit. So which means he is incurring a loss of 25 rupees. So for a long call to break even, your spot price has to be strike price plus the premium which you have paid. Strike price plus the premium which you have paid. So you will break even. A call option, a long call option will break even at a asset price of rupees 2,600. Anything lesser than that one, the call option buyer will be incurring a loss. So if you are expecting the market is going to be bullish, the price of the asset is going to go up, but you are not expecting the price to go beyond 2,600, you are better off by selling that particular put option and keep this particular premium. So you will take a short position in the market when your view on the asset price is bullish, but with limited upside. Okay, now let's consider a scenario. Somebody is selling this particular call option. If somebody sells this particular call option, he is taking a short position, and when he take a short position, he will receive this particular premium, and he will be expecting the market price to go down. The spot price to go should be lesser than the strike price on expiry, so that the option buyer, this particular option buyer, will find it attractive to buy it from the market rather than buying it from him, so that he can keep this particular premium. So his view on the market is bearish, but if his view is bearish, he can also buy a put option. So a put option gain its value when the spot price goes below strike price, and his gain is unlimited if he is buying this particular put option. Then why he is not doing that? Okay, for that, so for buying a put option, he has to pay 100 rupees premium, and on March 31st, let's assume that the spot price has become 2,480. The spot price has come down. It is lesser than the strike price, and if you take the value of this particular option, the option will not have a time value because the option is expiring on March 31st, but it can have an intrinsic value, and the intrinsic value is rupees 20. So 20 is the value of the option. So if this long position, if he wants to square it off, he has to sell it in the market, and he has to sell it at rupees 20. But he has bought this particular option at 100 rupees and he is selling at 20, so he's incurring a loss of rupees 80. So for a long put position to break even, you need to have your spot price to become equal to strike price minus the premium which he has paid. That is strike price 2,500 minus 100. So if the spot price goes below rupees 2,400, only in that scenario this long put become profitable for the buyer of this particular put option. So a short call, somebody will take a short call, somebody will be selling a call option when his view on the asset price is bearish, but with some limited downside. He is not expecting the price to go down beyond a point. And they are not the only sellers in the market. In an option market, you have somebody called a market maker. A market maker is a big broker, and in a given point in time he will give a two-way quote for both put option and call option, and he will be expressing his quotes with a bid price and an ask price. The bid price is the price at which he would be buying the asset, buying the put option, and ask price is the price at which he will be selling the put option. So similar is the case with call option. He will give a bid price and ask price for call option as well. And in a given point in time, he will be offering put option and call option for various strike prices of the same asset with different expiries as well. So let's consider this particular strike price of 2,650, for which the bid price is rupees 10 and ask price is rupees 12. So bid price is the price at which he will be buying this particular put option, and ask price is the price at which he will be selling this particular put option. And similar is the case with the call option, and bid price for this particular call option with a strike of 2,650 is rupees 5 and ask price is rupees 7. And in case if you want to buy this particular put option, you want to go long on this particular put option, then you will pay rupees 12 to the market maker, because this is the price at which he will be selling that particular put option. And on the other hand, if you want to short this particular put option, if you want to sell this particular put option, we know that for selling a put option you have to pay the margin. You will pay the margin to him, and on expiry, if the option is expiring out of the money, he will pay you the margin plus this premium, that is the bid price. And on the other hand, if you want to go long on this particular call option, then with a strike of 2,650, you will pay 7 rupees to him, which is the ask price. On the other hand, if you are going short on this particular call option with a strike of 2,650, you will pay the margin, and on expiry, if the call option is expiring out of the money, he will return you the margin plus this particular bid price. So this is how a option contract is transacted in the market. To give you an idea how it actually works in a market, please now let's go to National Stock Exchange website. Let's take one options contract. From the instrument tab, you go to change to stock options. Stock symbol is INFI. And like in the case of a futures contract, at a given point in time, the exchange offer option contracts with 3 maturities, one which is expiring on the current month, and the other one which is expiring the next month, and which is termed as near month contract, and the one which is expiring the month after that, which is generally referred as far month contract. And the option expires on the last Thursday of the month, and you can choose between call option and put option. So I'm just taking a call option here, and then you at a strike price for a asset which is for a stock which is trading at 1,069 rupees, you have strike prices ranging from 920 to 1,400. So depends upon your view on the market and the kind of strategy that you want to make. You can choose either of this. So let's choose one strike price over here. Yeah, the price of the price of this call option with a strike price of 1,060 is 27.95, and your option contract also has got a market lot, which means that the exchange specify the number of quantity in the one option contract. So one option contract of Infosys contains 500 shares of Infosys. So the total value of this contract would be the market lot multiplied by the price. And let's take the option chain as well. Yeah, this is the option chain for Infosys Technologies. which is with an expiry of 25th August 2016. So here, and the share is traded at 1065.05. Last day it closed at this particular price level, and you can see that you have strikes available from 840 to 1400, and the market makers have given offers for every strike, and they have given a bid price and ask price. As we have discussed, no, the ask price is more than the bid price, and the difference between these bid price and ask price is their profit. Yeah, and some of not every contract will have no will have market because of the liquidity and the views people have got on the price movement. So something a strike which is near to the current market price will be the actively traded ones. So let's look at these strikes. In these strikes, you can see that there is a bid price given and ask price given for. So this side represents, so the one which is right to the strike prices represents the call options, and one which is left to the strike price represents the put options. So for a strike of 1040, a contract which is expiring on 25th August, you have a bid price of 26 and an ask price of 27.95. And for the string put option, you have a bid price, ask price of bid price of 10.6 and ask price of 10.85. So if you watch carefully, you can see that there is a portion which has been darkened, highlighted on calls side as well as on the put side, and the one which is highlighted are the options which are out of the money, and one which is not highlighted is are in the money contracts. So as far as these call options are concerned, Infosys is trading at 1065, and we know that if the strike price, if the market price is higher than the strike price, then only the calls will become in the money. So one which is, so these strike prices are lower than the current market price, so this side represents the in the money call option. And on the other hand, we know that your put option occurs value, it will have intrinsic values when the uh, market price is lower than the strike price. So these strike price of put options are in the money. So if somebody wants to buy a strike, buy a call option with a strike price of 1060, he has to pay this ask price 27.95 to the market maker and buy this particular contract with a strike price Infosys call option at 1060. And on the other hand, if somebody wants to sell a call option with a strike of 1060 expiring on 25th August, then he has to pay the margin, and on expiry of the contract, if the contract remains out of the money, the exchange will repay the margin with this the bid price which has been given. And you can also see there is something called LTP that represents the last traded price of this particular option contract. So last traded price is the is the subsequent trade. You acquire a option contract from a market maker, and when you sell or buy subsequently in the market, that shows the last traded price. And this makes an option contract a hybrid market. An option contract has the features of a quote driven market as well as a order driven market. So because of the presence of the market maker, it works like a quote driven market. They will give a bid price and an ask price, and the subsequent transaction in the option contract is carried out as a order driven market. So this is how your options are traded in a actual market situation. All right. And to sum it up, to hedge using a option contract, and if your interest in the asset is sell, and then you will buy a put option. And to hedge with a buy interest in the underlying asset, you have to buy a call option. And if you are bullish, you buy a call option. And if you are bearish, you buy a put option. If you are bullish with limited upside, then you sell a put option. And if you are bearish with limited downside, you will sell a call option. Market makers offer a two-way quote on multiple strike prices of both call and put options of the same asset with multiple expiry. We have just seen that. So if derivatives are so innocent a product like this, so what makes it an economic weapon of mass destruction as described by Warren Buffett, the legendary investor? It is the excessive speculation. And the reason for the recent financial crisis can be traced back to bubbles created by speculators using highly leveraged derivatives position. And when the bubble burst, that results in a recession. And most of the time, the big banks that does most of the trading in these derivatives do it very well. They use extremely sophisticated computer algorithms that help them come out on the winning end of these bets. But when there is some sort of unforeseen event that suddenly causes a massive shift in the marketplace, that can cause a tremendous problem. This is what Mr. Buffett explained. The problem arises when there is a discontinuity in the market for some reason or another. When the market closed, like it was for a few days after 9/11 or in World War I, the market was closed for 4 or 5 months. Anything that disrupts the continuity of the market, when you have trillions of dollars of nominal amount outstanding and no ability to settle up, and who knows what happens when the market reopens. This is what he said. So if the markets behave fairly, calmly, and predictably, the derivatives bubble probably will not burst. But no balancing act of this nature ever lasts forever. Just remember what happened in 2008 when Lehman Brothers collapsed and then the entire financial system virtually froze up. And at that time, almost everyone was afraid to deal with the big banks because nobody was quite sure how much exposure they had to these risky derivatives. And this is a problem that the participants, regulators, and the system as a whole are yet to sort out. With that, we are concluding the second part of this particular presentation. And in case if you have liked this presentation, please do like below, subscribe to our channel, and also share this video and help us to get some views. Thank you so much, and you guys have great times ahead.